Hello and welcome to this special edition of Market Masters. We are in a bull market unlike any other. Comparing the current bull market to the previous one, which is between 2003 and 2007, now actually seems a bit underwhelming, isn't it? This one feels so much bigger, more broader and wider as well. And we're doing all of this with little help from foreigners. My guest today is someone who I think is one of the best articulators, thinkers about what is going on and where we are headed. I have with me Manish Chokhani of Enam. Manish, great to have you with us here on the program. Thank you very much.
Been a long time. Thanks for having me.
Thanks very much. Now, $4 billion a month mutual funds are getting. It's a flood out there. And by the way, it's increased. Pre-elections, pre-June elections, we were getting about $2 billion. It's now $4 billion a month. I mean, you would have thought numbers would go down. It's actually increased. Where are we headed? With the flow picture first.
Before the flow, I just want to take one step back. That as Indians, I'm just so happy that the kind of wealth creation which has happened in our country is unprecedented. And as you said, comparing it to 2 decades ago, while the percentage returns may look similar, the absolute amounts, remember we are at a $5 trillion market cap. And 85% of it is owned by Indians. There's only 15% foreign ownership. So the absolute amount of wealth creation which has happened in this bull run is just unbelievable. And hopefully it's a start of a virtuous cycle where you make the money, you reinvest it, you create more jobs and employment, you create more profits, and the cycle continues. So fingers crossed this continues. And like I said, the asset allocation mix of Indians, which we've been waiting for a long time to shift towards equity away from hard assets, is only just beginning. We are just 6 or 7% of assets are in equities. The bulk of it is still real estate and gold.
When this began, people could have argued that maybe this is a bull market phenomenon because people are chasing things, they're seeing other people make money. But this is now continued and it's actually becoming bigger.
When you see it continuing in, even through the drawdowns which have occurred, and this year we've had 2 or 3 major reasons for people to pull back. And this advent of SIPs, which the mutual fund has done an outstanding job, the whole industry, of getting people into the markets and not getting scared away at every downturn, I think is great. And remember, for context, if you remove the promoter holding, which includes the government and the 40% Indian ownership, remove the foreigners, the value of stocks with Indian investors per se is still less than the value of gold they're holding. And it's far below the value of the real estate they're holding. So it's easy to get scared away, but over the last 20 years, we never got scared that, oh my God, people might start selling gold because price is going up. And gold itself has been in a bull market during this entire episode and almost tracked the same returns as the index.
So you think this can continue? This will continue or at some point slacks off? What's your sense?
See, liquidity melt up. Remember we spoke last Diwali where I said in every decade since we broke this Bretton Woods gold standard and went to this dollar peg, we created bubbles in every decade. So in the 70s, it went to all the Nifty 50 stocks of the US. And of course, it culminated in the blowout of oil and gold and silver in that decade. Then it went to the emerging markets, which then was Japan and Taiwan in the 80s and completely blew off. In the 90s, it culminated in the NASDAQ bubble. In the 2000 to 2010, it came to BRICS, in which China was really the center of the bubble and commodities. And the last decade then went to TMT and the Magnificent Seven, which have got extended due to this excess money printing through COVID and so on. So for me, it looked like in context of history and market cycles that India would be the epicenter of the next bubble. And the conditions were ripe because the country is reaching a critical takeoff point. The economy is reasonably well governed. The entrepreneurship has been unleashed. The reforms are good. Infrastructure is getting built, both physical and digital. So, and this move that the youngsters were happier to take risk in financial assets as opposed to hard assets. So the culmination of all that still looks like we are still heading for a big melt-up. And I don't think it's over yet.
Where are we in that melt-up period?
If I knew that, I would be Warren Buffett, right? So that's $1 million answer.
But halfway through, early on...
No, look, I've been underwhelmed, to be honest, by the amount of foreign inflows. Like this year, I think we have, 15, 16 billion over a calendar. The last 12 months, maybe it's 20 billion. But 20 billion has come only through the JP Morgan
debt indices. So this year in
indices.
2024, FIs have put in about $7 billion to work. Locals have put in 39, I think, almost $40 billion.
So that's what I'm saying. The foreigners, I think, a couple of reasons, and this is just post facto justification, because I would have expected a lot more to come in. That number one, you're making a lot of money in your home market in US. And if US is 65% of the world, and remember, it's a $65 trillion market, And if India, even after the MSCI rebalancing is reaching 3%, and the global funds don't frankly look at India, and they will start looking at now. But let's say you get the 3% market wrong and it goes up a lot. You basically drag off 1%. But you're making like a couple of percentage on NVIDIA every week over there. So I think that's one reason. The other side of the world, which is Japan, Europe, they are basically dead. So it's the flip of that is happening, that when you're dying in your home market, you're not really looking to invest abroad. So that has to happen. And it's also, I think, a reason why FDI flows have been relatively subdued. So on both fronts. Although debt flows, which we expected with the JP Morgan index inclusion and then the others to follow, those flows have started coming. So I would still expect it's not even like the first inning in a baseball game analogy of the foreign inflows into India. And the domestic flows, remember, if they keep lifting this market, they've so far only lifted what I say quadrant 4. Quadrant 1, 2 and 3, which are really the large caps, which is where the bulk of the money of the market is, hasn't yet seen massive flows. And eventually every fund manager in the world, hand on heart, is a momentum chaser. So if this market keeps performing for long, they're going to be here. Because if it were only valuations, as they all claim, then everyone would have been buying China, which is the cheapest market in the world. So I think it's a story which is unfolding. And maybe they come in through primary issuances, where again we've not had the big companies coming with big issuances, neither from the government nor from the top 10 business houses. And that becomes then an entry point to start sucking in these flows.
Actually, I was at the JP Morgan conference yesterday, and they were telling me that there are lots of investors from mainland China there.
Interesting.
Interesting. So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
it makes a major long-term top, which is not a great thing. So I mean, it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market, where small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up, where the entire market goes up 10x in a decade. And then you don't see that prices for maybe next 10 or 20 years. So I'm hoping we don't get a melt up, and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplied. Having said that, the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or someone has come with massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is, the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and, of course, QIPs and so on. We've seen promoter selling, we've seen PE selling, we've seen MNC strategic selling, and it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting it right. But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we are a long way off from that climax. Or
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. All right. Manish, we're going to take a quick commercial break here. Stay with us. We're in conversation with Manish Chokhani of Enam. Welcome back to the special edition of Market Masters. We are sitting down with the one and only Manish Chokhani of Enam. Pullbacks are a regular feature of a bull market. It's just that this one has been without pullbacks.
Yeah, see, the fun and games actually this time has not been in... so again, let me step back. The top 11 companies are 25% of India. And average market cap there is in excess of $100 billion. And I'm just taking the NSE 500 at, let's say, $4.8 trillion. Of that, 25% is $1.2 trillion, which is 11 companies. So that's $110 billion average. Nothing's happening there. The next quadrant, which is from 1.2 to 2.4 trillion dollars, has another, I think, 31 companies, which gives you that average as well over there. Again, nothing. So the top 40 companies are half of India, and which is where the bulk of the foreigners were invested, and these stocks haven't actually really done very well.
Right.
And when we talk financials or Reliance or whatever, they've given decent returns, but it's underperforming.
Yeah.
Quadrant 3 is, I think, another 80, 90 companies. So 130 companies are 75% of India's over. It's harder to lift these companies because these are in the categorization of large caps, which is over a 50,000 crore market cap.
And these 130, 140 companies, about $3.5 trillion in market capital.
75% of 5 trillion, whatever it is.
Yeah.
So that you pretty much nothing has happened. And this is where the coverage universe of the brokerages used to be. This is where the FIs used to invest. This is where the mutual funds buy. By definition, they are large cap.
Yeah.
All these are over 50,000 crores. The whole action has been happening in whatever the balance 370 companies, which is in quadrant 4.
Yeah.
But it's $1.2 trillion. It's still a staggering amount. And therefore, the domestic wealth creation, like I can talk of it as if it's small, but it's thousands of crores of profits being made by investors, and people who thought their companies are worth 2,000 crores are seeing them at 20,000 crores now. Because everyone's trying to lift it up and get it into a mid-cap index or get it into the small-cap index and so on. The worry to me is that end of the market is trading at twice the multiple of the market. Now, historically, yes, a smaller company can grow faster, and we ourselves made our money in, the first era was all the Infosys and ZTVs and Maricos, which were compounding like crazy in the 90s. Yeah. But very small percentage of those companies, as I just explained, will make it from that 387 list to the 30 list or to the 11 list. Yeah. So the stock picking which you do there is important, because if you get that wrong, God help you. And I'll give you the most famous example of the best company in India, I can argue, is Infosys. It made a dramatic top in March of 2000. It was a $46 billion market cap back then. It basically doubled in 24 years, which is, nothing wrong, but 20-year double is, drastic underperformance for a fantastic company. Yeah. Company did everything right.
From the top of 2000 over the next 20 years,
46 billion to it's probably 93, 94 billion today. Yeah. The market is up from 6,000 to close to 90,000 or 84,000, let's just say. So it's what, 14 times up. The market is 14 times up. Forget what's happened to other companies. Whereas the best company probably only doubled. And of course, I'm excluding dividends and buyback, but add a few percentage points there. But it's not that dramatic. So when you get pricing wrong in a small cap, heaven help you. And why small cap? Even from the top of 2007, when Reliance kind of went to sleep then for the next 12, 13 years, you didn't make any return. Then it quadrupled during COVID when they did the Facebook placement and so on. And I think that's really the central risk in our market, that small caps and this SMID exchange, my God, it's I think some of the indexes up 80 times in the last 3 or 4 years. What's going on there is far, far bigger than the whole worries we have on FNO. FNO is a $4-5 billion problem in a sense of the losses being made. It's not insubstantial, but in the context of what's going to happen, maybe in this quadrant 4 of the market, as I call it, and this whole SME exchange, that's going to be painful.
That quadrant
losses.
4 includes the SME exchange?
No.
That's separate.
That's
right?
tiny, but a 12 crore issue attracts 5,000 crores of investments. Something funny is going on. And I'm not casting aspersions on the companies or the people, but who's putting 4,800 crore applications into a 12 crore issue? So something's going on, God knows. So those are the things you worry about.
Okay.
But having said that, the broader market, when I say the top 30, 40 companies, usually if something goes wrong there, that's when the market collapses. Or supply from there will overwhelm the market. But it can't be a quadrant 4 problem which blows up the market.
But you're saying that in quadrant 4,
right,
there's a problem in the sense...
The valuations are berserk over there. Again, great companies, but... And again, I usually don't talk about stocks, but just to put some sense. And again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example. Let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then, because it'll be a fairly large company. So it needs a $4 billion PAT, profit after tax, to get to a $4 billion PAT, just for context. Today, TCS with 6 lakh employees makes $6 billion. So, is this possible? How will they do it? Will they add more lines? I mean, Amazons of the world have done it. They started somewhere and they ended elsewhere. But if you're taking that bet, your time horizon has to be that, or your return expectation has to be that much lower. And that's the sort of stuff going on over here.
Got that. I want to talk about leadership in this bull market as well. And we'll get back to what to do and advice for investors a little later. So PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But people, defense, etc., right? That part, it looks like we're starting to rotate. People are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done? Or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate. And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like, what's wrong with these chaps? But because the correction had been so steep that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So, and people are shy of doing leverage after again the last cycle. The flip of it, to just complete, the leadership of the last cycle was all the high quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank,
consumers, retail.
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies, but it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very much.
And financials, right? I mean, advice for investors who are watching, Manish. I mean, because in many ways you're saying that a lot has happened. So one must be cognizant of that when you make fresh purchases.
So what happens, and again, it's something I've experienced in the past, so maybe that would be of benefit to investors, is, look, the market tends to be a 75% large cap, 20% mid cap, 5% small cap type market. And that's the distribution. Few of these will graduate to box 2 and few of these will graduate to box 1. So your normal portfolio allocation tended to be a 80-20 mix, that we would keep 80% large cap for safety and 20% to give you the alpha, to give you much better. Given that we guys also came back from, we built a lot of our wealth on the small and mid caps only. But when you start doing that, you realize your portfolio mix tilts because those companies become reverse. The small and mid become 80% of the portfolio and the large become 20. And whenever something goes wrong, like you had crises in 2008, 2018 even, for no fathomable reason, they can tend to fall 60 to 80%. And that is very, very damaging for the portfolio. And that is what really scares you out of the market. Like, again, the same famous example of Infosys. It went from 16,000 to 2,700, which is like almost more than an 80% fall in a high quality company. Because when that happens, liquidity, you'll be surprised, it just vanishes in the stock and you just can't get out. And what you think my portfolio value is, whatever, 100 rupees, it looks like it's less than 50 suddenly. So if you can just keep tilting your portfolio, that if your asset allocation is okay, that you may have maybe 50, 60, 70% of your money in equities. It's very easy right now to feel you're making so much money, get out of banks, liquidity or whatever, put it all in the market. If you're not prepared for a downturn in the market, then you'll get scared out. So asset allocation to equities, number one. Within that, what is your mix in your portfolio? Be very cognizant. too much concentration in a small or mid category or too much concentration in one sector. Again, for example, the parallel of TMT in the 2000s. If TMT became 50-60% of your allocation and that fell by 50-60%, where were you? So just be cognizant of portfolio balances. I'm not suggesting this is better or that is better, but just do what's right for you and what stage of life you are at. So I'm finding people who are 60, 70. I have a cousin who's 74 years old in another city, and she's calling up and she wants to buy small caps. She wants to buy like the three most powerful, high volume stocks in India nowadays with 60 lakh shareholders, or is it 60 lakh or 60 million? I don't know. A Yes Bank, Idea, and Suzlon. I mean, maybe it's great companies and they have a view on it, but I mean, is it the right stock for you? First, you think about that. People will call up and if they'll ask me, should I buy a bank? And if I end up saying ICICI or HDFC, they're like, but Yes Bank goes up every week. Again, nothing wrong with it. But is that right for you? So just think of allocation in your portfolio and what you're doing.
And the other point I think which you made before as well, riding existing winners is one thing. Going into
that's
new
absolutely
things,
right. So when you're in the middle of a cycle, most horses are going to run. Don't be impatient if in this cycle, this horse handles another. For example, if let's say financials haven't run and you feel, oh my God, defense and railway is running, and you leave this and you come to this horse and this horse is already run and it's ready for a down drift or a sideways move. And you've jumped here and you know less about this than you knew about that. It's going to be damaging again if something wrong happens over there. So I think just stay away from what I call FOMO. This is not a FOMO moment in life. Don't get greedy. Returns have been extraordinary and there's no reason India won't. I still think 90% of our wealth lies ahead of us in the next 20 years. If we do 4 times in 10 years and we again repeat the 4 times in the next 10, it's 16 times. Even if we don't do 16, we go 10x from here. You really have to have patience over here. That's all. You get the right companies. If they're around 20 years from now, believe me, you'll be really wealthy.
So it's not a sprint from here.
It's not a sprint. Don't
we've
try
had
to
a
keep
sprint,
jumping.
but it's not a sprint.
Yeah, I mean, it's like in an era of T20, I'm advising play like a test cricketer.
Yeah, but because you have played T20 already. I mean, most have played the T20 game. Now it becomes more of a test match.
True.
Right.
So I think just be a bit relaxed. I think the country's future is bright.
Right.
The entrepreneurship is still very much there. The potential for growth over here is still very much there. When I look around the world, they're all ex-growth, highly indebted, waiting to blow up. So the opportunity is here, but just don't blow yourself up in the process.
You've got to stay in the game. You've got to be around, essentially.
Like Buffett used to say, 2 rules of investing. Rule number 1, don't lose money. Rule number 2 is don't forget rule number 1. I think that's all you can do.
That's such a wonderful way to wrap up this conversation, Manish. Thank you so much for dropping by and thank you for sharing all that wisdom with us.
Thanks for having me.
Thank you.